The assumption almost every retirement video makes, including ones I have made, is that more Roth is always better. After 25 years sitting across from a real people making real retirement decisions, I want to offer you something different today. Not a counter-argument, a more honest picture. Because here is what I actually saw happen in my practice. The people who benefited most from Roth conversions were not the typical retiree. They were a specific subset. And if you are not in that subset, and many of you watching this are not, converting aggressively could quietly cost you more than it saves. By the end of this video, you will know exactly which situation you are actually in, and that clarity alone may be worth more than any conversion strategy. One specific anchor before we go further. There is a 2-year timing detail buried inside Medicare rules that surprises nearly everyone who hears it, and it can turn what feels like smart planning into an expensive mistake. We are going to get to that. Stay with me. Before we jump into Roth conversions, let's ground this in some real data. Here is something that surprised nearly every client I worked with once I showed them the numbers. According to the Federal Reserve's Survey of Consumer Finances, the median financial assets for households aged 65 to 69 is approximately $135,000. That is not a small number, but it is also not the million-dollar balance that most Roth conversion conversations are built around. Now, look at what typical retirement income actually looks like. When you factor in Social Security, any pension income, and portfolio withdrawals, most retired households are living on somewhere between $50,000 and $65,000 a year. Some are above that, many are below. But that is the center of the distribution for people who have worked carefully and done things right. And here is what that pairing tells you. If your household investment assets are in the range of $100,000 to $200,000 and your retirement income falls in that $50,000 to $65,000 range, your tax picture in retirement is likely already quite favorable. The standard deduction for a married couple over 65 is substantial. Social Security is only partially taxable at those income levels. Capital gains may be taxed at 0% federally. You are not in a situation where taxes are quietly eroding your retirement. Picture two columns side by side. On the left, your annual retirement income. On the right, the deductions and favorable rates working in your favor simply because you are retired. For most middle-of-the-road households, those two columns are closer to balanced than most financial content would lead you to believe. That distinction matters because Roth conversion conversations are often written for a different person than you. They are written for the aggressive saver with $1.5 million in a traditional IRA, facing large required minimum distributions and a tax bill that genuinely compounds. That is a real situation. It's just not everyone's situation. And if it's not yours, the calculus changes significantly. When you're in a higher tax bracket now than later. This is the most fundamental reason a Roth conversion may not serve you, and it's worth being direct about it. When you convert money from a traditional IRA to a Roth, you're paying taxes today on dollars that would otherwise grow and be withdrawn later. The logic only works in your favor if the rate you pay today is lower than what you would have paid on future withdrawals. The moment that equation flips, the moment you're paying more now than you would have paid later, a conversion destroys value rather than creating it. I think about a woman I worked with years ago, a retired teacher from Columbus, 63 years old, 31 years in the classroom, and a small pension paying just over $1,100 a month. She had $186,000 in a traditional 403(b) and a modest savings account. She came to me in the fall of the year she retired, having just read an article about Roth conversions. She was ready to move forward. She had already called her brokerage. The assumption she was carrying was one I heard constantly, that converting early was always smarter because taxes would only go up. It's a reasonable assumption. It's also not always true. Here's what we found when we ran her numbers. With her pension, partial Social Security she planned to take at 65, and the standard deduction plus the additional senior deduction available to her, her effective federal tax rate in retirement was going to be genuinely low. Converting 40,000 in a year when she still had earned income from a final semester of substitute teaching would have pushed her into a bracket she would never see again in retirement. She would have been prepaying taxes at a rate she was never going to face on a withdrawal. She paused. Then she said something I still think about. So I would have been solving a problem I don't actually have. That sentence is what this decision is really about. If your retirement income naturally fills the lower brackets, and for many careful savers it does, converting aggressively means giving up cheap rates later to pay higher rates today. That's not a win, and it's not a mistake that's easy to undo. Roth conversions increase your modified adjusted gross income. Now here is the part many retirees overlook, and it's the detail I promised at the beginning. When you convert money from a traditional IRA to a Roth, that converted amount is treated as ordinary income for that year. It raises your modified adjusted gross income. And once your income crosses certain thresholds, Medicare charges you more for the same coverage. This is called IRMAA, the Income-Related Monthly Adjustment Amount. What makes this particularly important is the timing. Medicare doesn't look at your income in the current year, it looks back 2 years. So if you retire at 63 and spend those gap years doing large conversions, Medicare is going to see that income when you enroll at 65. And IRMAA doesn't ease in gradually, it works like a cliff. Cross a threshold by $1 and the surcharge kicks in for the entire year. For a married couple, the difference between just under and just over one of those thresholds can be several $100s a month in additional premiums, multiplied over 12 months. Then it resets and the calculation runs again. This doesn't mean conversions during those gap years are wrong. It means the math has to include this calculation, not just the tax bracket comparison. If you're planning conversions in those years between retirement and Social Security, knowing the IRMAA thresholds is not optional. It's the number that tells you how much to convert and when to stop. Here's a best practice idea for Roth conversions. Most people think about whether to convert. Fewer think about how to pay for it. And that distinction matters more than most realize. When you convert, the taxes are due in the year you convert. You can pay them one of two ways, from money inside the IRA itself or from outside savings you already have. Using IRA money to pay the taxes means fewer dollars reach the Roth. You are converting less, and the amount that enters the tax-free environment, the whole point of the exercise, is smaller. Over time, that erosion compounds. Using outside cash, a savings account, a checking account, money earning a modest return and losing ground to inflation, means the full converted amount enters the Roth and begins growing tax-free immediately. Those outside dollars get their most productive assignment. If you do not have outside cash to cover the conversion tax, that is not necessarily a reason to abandon the idea, but it is a reason to convert a smaller amount, one that outside money can fully cover, rather than a larger amount where the taxes come out of the account itself. If your kids will likely be in the 12 or the 22% bracket. Here is something that surprised nearly every client I worked with when we brought legacy planning into the conversation. If you are carrying a traditional IRA with the intention of leaving it to your children, the relevant tax rate is not yours. It's theirs. Your children will inherit that account and, under current rules, are generally required to withdraw it over a 10-year period. If your children are in the middle of their own peak earning years when they inherit, and statistically many are, they may absorb those withdrawals into an already substantial income. But here's the honest reframe. If you are in a low tax bracket in retirement and your children are in a higher one, converting at your favorable rate could be genuinely valuable for the family. Some families have approached this creatively. Adult children help cover the conversion taxes during the parents' retirement years, so the account passes to them tax-free. That is not a strategy for everyone, but it is a real one. The oxygen mask principle matters here. Your retirement income security comes before legacy planning. Always. Anything you leave behind is a gift, a generous one, not an obligation. Do not convert in ways that reduce your own financial flexibility in order to optimize an inheritance. Some retirees end up with years where their tax is far more favorable than they expected. This is the detail that quietly changes the math for a lot of people, and it almost never comes up in general Roth conversion discussions. If you have significant medical expenses in a given year, those can be deducted once they exceed a percentage of your adjusted gross income. For retirees managing ongoing health conditions, that deduction can be substantial, and it can make a traditional IRA withdrawal nearly tax-free in practice. Qualified charitable distributions, QCBs, work similarly. If you're 70 and a half or older and charitably inclined, you can send money directly from a traditional IRA to a qualifying charity, up to $105,000 per year under current limits. That amount satisfies your required minimum distribution for the year and never appears in your taxable income. The charity receives the full amount. You owe nothing on it. That's not a strategy most people discover until they're well into retirement, but it is one of the most efficient tools in the entire tax code for someone in the right situation. If you convert everything to a Roth too early, you lose access to both of these. The traditional account, the one everyone tells you to empty, may be carrying more built-in tax advantages than you realize. Roth conversions tend to work best in what planners often call gap years. But this is where the numbers start to behave differently than most people expect. The gap year window, those lower income years between when you stop working and when Social Security begins and required minimum distributions kick in, is genuinely valuable for conversions when it exists. Income is lower, brackets have room, the math can work in your favor. But not everyone has a gap year. If you work until 70 and claim Social Security immediately, there's no window. Your income moves from full working income to Social Security plus distributions in almost one step. If you retire and need Social Security right away because your budget requires it, the window doesn't materialize. If RMDs begin before you've had meaningful years of reduced income, the opportunity was never there. For people in these situations, conversions would happen while earned income, Social Security, and eventually RMDs are all layered on top of each other. That combination keeps you in the same brackets you occupied during your working years. Converting there is not a strategy. It's paying a premium for an account type that was built to benefit a different version of your financial picture. State taxes can make a huge difference in whether a Roth conversion makes sense. Think about where you live right now and where you plan to be in 10 years. This is one of the most consistently underestimated variables in the conversion decision. States treat retirement income in very different ways. Some fully exempt pension and IRA distributions from state income tax. Others tax them the same as earned income. A few have no income tax at all. If you live in a high-tax state right now and plan to move somewhere with lower or no income tax in retirement, doing a large conversion before you move adds a state tax layer you were going to escape anyway. Depending on your state rate, that could be 5, 6, or even 10% added on top of the federal bill for income you could have withdrawn later at no state cost. The reverse is also true. If your current state does not tax retirement distributions, conversions done now face only the federal rate. That is an automatic savings compared to converting after a move to a state that does tax them. The state question is not a minor footnote. For some people, it is the deciding variable. It belongs in the calculation alongside every other number. Take a moment with this before we go further. We have covered a lot of ground. Brackets, Medicare, legacy, state taxes, gap years. And I want to slow down because this is a good place to check in with yourself. If you are watching this and feeling like the Roth conversion conversation has been more complicated than you were led to believe, that is the honest truth. It is not simple, and anyone who tells you it is always the right move for everyone in every situation has not sat with enough real people to know what every situation actually looks like. Think about your own household before we move on. The income you expect in retirement, the accounts you have, traditional, Roth, brokerage, anything else. Ask yourself honestly, which category does my situation actually fall into? That question is worth 20 minutes of quiet thought, more than a dozen articles. Converting just because the Roth is better really is one of the most common mistakes. Here's the organizing idea I want to leave you with. A Roth account is a remarkable tool. Tax-free growth, tax-free withdrawals, no required minimum distributions during your lifetime, flexibility that is genuinely hard to put a number on. None of that changes. But a tool is only valuable when it is the right tool for the job in front of you. A Roth conversion is not a universal answer. It is a specific solution to a specific problem. The problem of a tax rate that is meaningfully lower today than it will be in the future, with enough time and enough assets for the math to prove out. For the middle-of-the-road household, careful savers, modest balances, income that fills the lower brackets in retirement, that problem often does not exist in the form it's described. Trying to solve a problem you don't have at a cost you didn't need to pay is one of the quieter ways retirement math goes sideways. The people who benefit most from aggressive Roth conversions share a specific profile: high earners, large traditional balances, meaningful gap years, and a tax situation that's genuinely going to worsen over time. If that's you, conversions deserve serious attention. If it's not, the traditional account you've been thinking about emptying may be doing exactly what it was designed to do. The strategy worth your time is not conversion, it's optimization, understanding the tools you already have well enough to use them precisely when they matter most. Before you close this video, I want to give you one concrete thing to do. Write down the total balance in your traditional IRA or 401k. Then, estimate what your required minimum distribution would be at age 73. A rough starting point is dividing that balance by 26.5. Now ask, given everything else I expect in retirement income, is that number a problem? Or would it be manageable, even favorable, given the deductions and rates available to me? That one exercise will tell you more about whether a Roth conversion belongs in your plan than anything else I could say. If something in this video clarified a question you've been carrying, I would genuinely like to hear it. Drop it in the comments. I read every one, and your question is often something several others are sitting with too. If someone you care about is working through these same decisions, send this to them. This kind of clarity is always easier when you're not figuring it out alone.